Most traders dream of flipping at 100 account into 7 figures, but Richard Wyckoff would tell you that fortune doesn't reward dreamers. It rewards operators with discipline. Picture a young trader watching a tiny 100 account dance at the edge of ruin, tempted by every spike, every candle, every opportunity. But instead of chasing noise, he studies the market's true heartbeat. Accumulation, markup, distribution, markdown. One day, during a quiet phase that most traders ignore, he recognizes a classic Wyckoff accumulation: price compressing, volume drying, strong hands absorbing the weak. He enters not because he hopes, but because the market confirmed its intention. That 100 position grows, slowly at first, deliberately, compounding through cycles. Not luck, not gambling. Methodical execution born from understanding the composite operator. This is the mindset that transforms small accounts into legendary ones: patience over impulse, structure over guessing, and alignment with the market's intention, not your emotions. Ladies and gentlemen, every trader enters the market with the same dream: to turn a small stake into a fortune. But in my decades of studying market behavior, I've learned that the size of your account has never been the true barrier. Your mindset is. The market does not pay the impulsive, the hopeful, or the emotional. It pays the operator who thinks in phases, acts with discipline, and reads the silent intentions of the composite operator behind every movement of price. Today we are not talking about luck, shortcuts, or fantasies. We are talking about the mental framework that transforms a modest 100 account into a 7-figure portfolio. Not through magic, but through mastery. The mastery of self, of structure, and of the market's timeless laws. In trading, the gulf between a 100 account and a 7-figure portfolio is not bridged by strategy alone. It is bridged by discipline. Wyckoff observed that the average trader is ruled by impulse, reacting to every price flicker as if the market were a slot machine. The professional, however, approaches the market as a structured operation. Discipline becomes the very architecture of his success. The amateur asks, "What can I make today?" The disciplined operator asks, "What does the market permit today?" Impulse is the greatest tax on small accounts. It shows up as chasing breakouts, panicking at minor retracements, forcing trades because the trader feels left out, and holding losers because emotions override logic. With a 100 account, every mistake is magnified. A single impulsive entry can destroy weeks of disciplined progress. Wyckoff teaches that price does not move randomly. It moves with intention. But to see that intention, you must be still long enough to observe, not react. Consider the market's 4 phases: accumulation, markup, distribution, and markdown. Without discipline, a trader sees only candles, noise, and volatility. With discipline, he sees structure. He waits for a change of character, a test, a sign of strength or weakness, not because these concepts are magical, but because they reflect the underlying activity of the composite operator. This waiting requires emotional control. It requires the ability to watch the market move without participating. It requires accepting that missing trades is far less costly than entering the wrong ones. Discipline over impulse also manifests in risk management. A 100 account forces precision. The disciplined trader risks small, went 2%, even when the temptation to go big whispers promises of fast wealth. But Wyckoff warned that the market punishes overconfidence more quickly than it rewards aggression. The disciplined trader understands that consistent small gains, compounded over months and years, will outperform the emotional trader who blows up repeatedly. It is not how fast you grow, but how long you survive. The disciplined operator also documents everything. He journals entries, exits, emotions, mistakes, and setups. This habit is not glamorous, but it is the foundation of transformation. Impulse lives in the moment, discipline lives in the data. By reviewing his performance, the trader learns his own tendencies, when he is most likely to overtrade, what triggers revenge trades, what conditions lead to errors. He begins to replace emotional reactions with rules and processes. Wyckoff believed that the market is a mirror, showing you your own weaknesses more clearly than any life circumstance. To become disciplined is to confront yourself. Finally, discipline builds confidence. Not the fragile confidence of guessing right, but the durable confidence of operating within proven principles. When you trust your method, you no longer fear missing out, nor do you rush to force trades. Your 100 account becomes a training ground for mastering composure. And when your mind is disciplined, capital naturally follows. 7-figure results are not created by genius. They are created by the trader who is willing to do what others cannot, control their impulses, and remain faithful to the plan. If there is one perspective that separates the professional operator from the public, it is the ability to think in phases rather than in candles. Wyckoff devoted his career to revealing a simple but powerful truth. The market does not move in random bursts, it moves through deliberate cycles engineered by large, informed interests. The composite operator. Phase-based thinking is the mental shift that allows a trader, even with a small 100 account, to step out of the chaos of the moment and into the organized structure beneath price. It transforms trading from guesswork into observation, from reaction into interpretation. The 4 phases, accumulation, markup, distribution, and markdown, represent the market's natural rhythm, but most traders treat the market like a chaotic heartbeat, reacting to each tick as if it carries isolated meaning. This is the mindset that destroys small accounts. A 100 account cannot survive impulsive trading in the middle of a phase it does not understand. However, a trader who identifies the phase early gains a decisive advantage because the phase reveals the market's intention. During accumulation, price moves sideways, appearing dull and directionless to the untrained eye. Volume often contracts, volatility decreases, and the public grows bored. But the operator who thinks in phases sees quiet accumulation by strong hands. He waits for the signs, springs, tests, absorption, signals that the composite operator is building a position. The impulsive trader sees nothing happening. The phase-aware trader sees opportunity developing. When markup begins, price breaks structure and moves upward with conviction. Impulsive traders chase this move, entering late and exposing themselves to sudden pullbacks. But the phase-based trader entered during accumulation when risk was controlled and intention was clear. His small account grows precisely because he aligned with the beginning of the movement, rather than reacting emotionally to the middle of it. During distribution, the public becomes euphoric. Every candle seems like a promise of more profit. Yet the phase-based thinker recognizes the subtle clues: failed breakouts, climaxing volume, upthrusts, weakening demand. He understands that the composite operator is unloading, not accumulating. While the crowd buys the top, he prepares for reversal. Finally, markdown arrives and prices decline. The impulsive trader panics, selling near the bottom or going short too late. The phase-based trader, however, anticipated this shift and positions accordingly or stays out entirely, preserving capital and preparing for the next accumulation cycle. What makes phase-based thinking especially powerful for small accounts is its ability to filter noise. A 100 account cannot withstand randomness, but it thrives when placed only in high-probability environments, especially early in phases where risk is minimal and reward is substantial. By waiting for the completion of a phase and confirmation of intent, the trader eliminates reckless entries and only participates when the market structure supports the trade. Phase-based thinking also removes emotional trading. When you see markets as a series of structured phases, you stop fearing every pullback and stop chasing every rally. You operate with clarity. You interpret before you act. You observe the footprints of the composite operator and move only when the phase confirms your thesis. This mindset does not just create better entries. It creates consistency, confidence, and longevity. the pillars required for turning a small account into a seven-figure one. A trader who thinks in phases thinks like the market itself, and that alignment is the foundation of professional success. Wyckoff's greatest gift to traders was not a pattern, a setup, or a chart rule. It was a way of thinking. The composite operators he CO'd is not just a theory, it is a mental model that allows a trader, even with only 100, to see the market as the professionals see it. When you adopt the composite operator mindset, you stop reacting to price and start understanding the intent behind price. And intention, not noise, is what creates million-dollar outcomes. The composite operator represents the collective actions of large, well-capitalized participants, institutions, hedge funds, market makers, syndicates, and deep-pocketed professionals. Their activities are purposeful, strategic, and patient. They do not chase, they do not panic, they do not guess, they build campaigns. For a small trader, the power lies not in matching their capital, but in matching their perspective. The CO mindset begins with one question: if I were a large operator, how would I accumulate, mark up, distribute, or mark down this market? Suddenly, the chart transforms. What looked like random movement becomes a sequence of deliberate operations. During accumulation, the composite operator buys gradually, quietly, without attracting attention. Price moves sideways, volume often contracts, and the public loses interest. The untrained trader sees stagnation, but the CO-minded trader sees stealth accumulation. He knows a campaign is being built. He recognizes absorption, higher lows, drying liquidity, and tests, not as coincidences but as footprints of an intention to move price upward later. During markup, the CO allows price to rise in a controlled manner. This is not generosity to the public. It is part of the campaign. The upward move encourages breakout traders, momentum chasers, and FOMO entries to join the rally, providing liquidity for the CO's earlier positions. The CO-minded trader rides these waves not emotionally, but structurally. He knows markup is simply the execution of the operator's plan. During distribution, the composite operator unloads positions onto an excited public. This is the phase where everyone on social media screams, "Bullish!" and price explodes upward, but on weakening demand. The CO-minded trader sees the shift. He reads the upthrusts, the failing breakouts, the stop-hunt wicks. He understands the operator is not buying here, he is selling, so the trader manages exits, tightens risk, or prepares for a reversal. During markdown, the composite operator allows price to decline sharply, triggering panic selling, stop-loss cascades, and emotional capitulation. The public cries manipulation. The CO-minded trader recognizes this as the operator simply completing the cycle. Thinking like the composite operator changes everything. You stop being the hunted and start becoming the observer. You no longer ask, "Should I buy now?" You ask, "What is the CO doing here?" When you align your trades with the actions of the operator, your small account becomes protected. You avoid emotional entries. You avoid traps. You avoid being the liquidity. Aid 100 account grows into 7 figures not by predicting markets, but by partnering with mindset, the entity that moves the market itself. The composite operator mindset turns the trader from a victim of the market into a student of its architecture. And once you understand the architect, you no longer fear the structure. You navigate it with intention, precision, and confidence. One of the most misunderstood truths in trading is that large accounts are not built through large moves. They are built through patient growth. Wyckoff emphasized repeatedly that successful traders do not measure progress in days or weeks, but in campaigns, cycles, and phases. When you understand this, the entire concept of turning a 100 account into 7 figures stops being a fantasy and becomes a process. Not a fast journey, not an easy one, but a structured progression built on the compounding power of patience. Patient capital growth begins with the acceptance that every account, no matter how small, carries one irreplaceable resource: time. Traders blow up not because they lack opportunity, but because they try to compress time. Impulsive traders want their 100 to become 10,000 by Friday. They over-leverage, they chase trades outside of structure, they force setups that do not exist. Wyckoff would call this the emotional trader's downfall, the attempt to outperform the market through speed rather than through understanding. But the patient trader approaches the market the way the composite operator does, through gradual accumulation, controlled exposure, and phase-based compounding. He knows that real growth occurs not through explosive wins, but through consistent, structured decisions aligned with the market's intention. Patient capital growth means refusing to trade conditions you don't understand. Many small account traders believe they need to trade every day. Wyckoff warned that inactivity is often the most profitable position. A patient trader waits for the market to reveal accumulation before buying, distribution before selling, and tests before committing. This transforms the account from an emotional playground into a disciplined instrument. It also means risking small, again and again. A 100 account cannot tolerate emotional risk. The patient trader risks 2% per position, knowing the power of small compounding. A series of steady 2–3% gains per week multiplies rapidly, but only for the trader who survives long enough to compound. The impulsive trader tries to double the account in a single trade. The patient trader focuses on not losing the account in a single trade. Wyckoff observed that the composite operator always builds positions over time, never all at once. Patient capital growth mirrors this. You do not make 7 figures from aggressive deposits or oversized bets. You do it with deliberate entries exited intelligently, repeated across dozens of market cycles. Patience also creates clarity. When you are not desperate for fast gains, you see the market more objectively. Your emotions cool, your judgment sharpens. You recognize accumulation instead of confusion, distribution instead of excitement. Emotion clouds vision, patience clears it. Most importantly, patient capital growth rewires your identity as a trader. You shift from someone trying to escape a small account into someone mastering the craft of growing it. This identity shift is critical. Small capital does not limit your potential, but impatience does. A 100 account is simply the first chapter. Every professional trader began with a first account, often small, often humble. What separates those who scaled to 7 figures is not their starting balance, but their patience. Wyckoff taught that the market rewards those who align with its rhythm. And the market's rhythm is not fast, it is cyclical, deliberate, and slow. Patient capital growth means moving with the market, not ahead of it. It means understanding that your account size is temporary, but your discipline is permanent. When patience becomes your foundation, growth is not a matter of if, but when. If there is one principle that separates professional operators from emotional traders, it is this: every decision must be backed by evidence. Wyckoff built his entire methodology on the belief that price and volume reveal the truth of market behavior. If you know how to read them, evidence-backed execution is the discipline of acting only when the market has confirmed its intention, not when your emotions have convinced you that something might happen. For the trader growing a 100 account into 7 figures, this principle is non-negotiable. It is the difference between building an empire and blowing up in a single trade. Evidence-backed execution begins with clarity, not prediction. The average trader enters a position because they feel bullish, think something is oversold, or hope for a reversal. But hope is not a strategy. Wyckoff taught that the market continually broadcasts evidence through its structure: higher highs, lower lows, diminishing volume, tests, springs, upthrusts, absorption, climaxes, and changes of character. These are not random events. They are signals of the composite operator's activity. The disciplined trader acts only when these signals align. Consider accumulation. An impulsive trader buys simply because price is low, but the evidence-backed trader waits. He looks for a selling climax, an automatic rally, secondary tests, a spring or shakeout, and finally a successful test on low volume. Only when these pieces align does he execute. His entry is not based on guessing. It is based on verified intention. During markup, the public rushes into trades without structure, buying every green candle. But the evidence-backed trader reads the strength-wide spreads, increasing volume on rallies, shallow pullbacks, and strong demand. He executes not because the trend looks exciting, but because the market is presenting objective proof of continued strength. In distribution, most traders go blind. They see new highs as confirmation of endless bullishness. Wyckoff-trained eyes see the opposite upthrusts. Exhaustion, trapped buyers, declining demand, and signs of weakness. Evidence-backed execution means selling or shorting only when these signals complete, not when fear or greed whispers into your ear. Another critical part of evidence-backed execution is waiting for confirmation instead of anticipating it. Many small account traders destroy themselves by entering too early. They want to be the first. They want to catch the exact top or bottom. But Wyckoff reminded traders that professionals do not care about being first. They care about being right. A 100 account cannot afford premature entries. Confirmation is your insurance. Evidence-based execution also applies to risk management. You do not hold a losing trade because you believe it will come back. You exit because the market has shown evidence that your original trade thesis is now invalid. You adjust stops based on structural shifts, not emotional discomfort. You scale in only when the market proves continuation, not because you want more profits. This approach rewires your trading psychology. When every decision is anchored in proof, uncertainty decreases. Overtrading disappears. FOMO evaporates. Trades become deliberate, clear, and repeatable. You evolve from a gambler into an operator. A 100 account transformed into 7 figures is not built on luck, prediction, or emotional reactions. It is built on thousands of decisions grounded in evidence. Wyckoff taught that the market leaves footprints. Evidence-backed execution is the discipline of stepping only where the market has already stepped. This is how small accounts become powerful accounts, not through hope, but through proof. Not through emotion, but through structure. Not through guessing, but through evidence. Turning a 100 account into 7 figures is not a story of luck, speed, or guessing. It is a story of mindset, discipline, and methodical execution. The journey begins with discipline over impulse, mastering the self before mastering the charts. It continues through phase-based thinking, understanding accumulation, markup, distribution, and markdown as the language of the market rather than random price movements. By adopting the Composite Operator Mindset, we begin to see the market as it truly is, a reflection of informed, patient, and strategic activity. Growth follows only when we embrace patient capital growth, compounding small, high-probability gains over time and resisting the temptation of instant gratification. And at every step, we practice evidence-backed execution, entering and exiting only when the market confirms its intention, not when our emotions demand action. When these principles align, discipline, structure, operator insight, patience, and proof, the market stops being a battleground and becomes a classroom. Small accounts are no longer handicaps. They are training grounds for developing the mindset, habits, and precision that scale naturally into 7-figure results. This is not fantasy. It is Wyckoff's timeless law. The market rewards preparation, patience, and perspective. Trade like the operator, act with evidence, wait with purpose, and your account, no matter how small, will grow not by chance, but by design,